Well, g'day there traders and friends, market participants and enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down and bring you this pre-market update dated Thursday the 13th of October 2016. The reason for this analysis, or the purpose for this analysis, is really just to address a lot of the uncertainty which is taking place in the markets, really across the board, the Dow, the S&P, and to a lesser degree the Nasdaq. The Nasdaq has held up rather stronger than that of the two other counterpart markets. However, these two counterpart markets, i.e. the Dow and the S&P 500, have been relatively flat. They have been rather stagnant really since the beginning of September 2016, and really a really quite easy way, or a simple way to conduce this and just to visually show you this is to bring up the Bollinger Bands. Now the Bollinger Bands, as you can see by this upper band and the lower band, is that it's really constricting price. This has been the trading action over the past, or really if we take into consideration from the 9th moving forward, over the past 3 to 4 weeks. And price is starting to coil, or at least the price bands are starting to coil. And what this means is that yes, volatility has been up and down, back and forth. We have seen some rather large daily gains. However, relatively soon thereafter, most of those gains have been given back by little waves of selling pressure. But overall, the net momentum has been rather neutral. Now, the best way to in many ways address this, or at least to trade this, is to remain neutral. It's not to say that, look, this setup is bullish, nor is it bearish, but it's at least a highlighting aspect to say, look, once these price triggers are pierced, and eventually one of these price triggers will be pierced either to the downside below 17,970 or above 18,462, it will allow us to jump in on that next wave, depending on which direction that is. Now, the reason for this, and at least the reason why we can say this, is that we have been building some very nice structural support, and we also have been building some very nice structural resistance. And again, we haven't broken out of this. Whether you want to call this a larger wedge, or if you just want to call it a Bollinger Band squeeze, it doesn't really matter. What you need to understand is that at the current juncture, there is a lot of uncertainty. There are a lot of people sort of scratching their heads trying to unlock price patterns, or at least momentum in the market. And across the board, markets are rather bifurcated. We have seen the markets recently break out to new all-time highs. That was during the month of July 2016. However, since then, once again, they've failed. They've stagnated. Is this the back test? Is this the back test of resistance, which is going to act up as, or at least hold up as support, where we're going to see the markets bounce and continue their intermediate trend to the upside? Or is this going to be some form of an inflection point, a turning point, where we're going to see the market structurally break support? And if that is the case, we are going to see a relatively considerable sell-off, which I think is going to take a lot of people off guard. Rough estimates, okay? Depending on price at the moment, and of course, this is through to the beginning of open on Thursday. If we start to break 17,970, the first price target, which I'll be looking at on the Dow Jones Industrial Average, is below 17,500, maybe even closer to 17,100. We'll have a look at this primary trend line in the future at some later date when the market makes it move, but that is a very rough target. Once the Dow cracks 17,970, a lot of individual trades are going to be moving in that direction. So if you find yourself inactive in the market, if you've been looking at this market, following it closely, and you're still yet to pull the trigger on individual trades, that is a good thing. That is a healthy thing. That is a constructive thing to be doing, or not to be doing, so to speak. When the market is bifurcated, when it is confused, when the overwhelming majority of analysis is in one direction or another, sometimes it's best, or oftentimes it is best, to be inactive in the market and to follow it from afar until, of course, certain levels are breached. And these are the levels which I'm walking through with you now on the Dow Jones Industrial Average. That level, once again, 17,970. On the upside, I'm paying attention to personally 18,462, and until the Dow either moves above or below this level, I'm going to remain inactive on the market and watching it from afar. A very simple setup is taking place on the S&P 500. Again, you can see these Bollinger Bands setting up. It isn't as nice of a squeeze as the Dow Jones Industrial Average, but it is, a rather decent squeeze. I mean, you can see right here, 2,118, that will be the structural break of this support, which has been building since September 9th. And again, on the upside, if this market wants to continue its trend, that's fine with me, that's okay, but I will not be jumping on board with it until we start pushing above 2190. To be more precise, 2191 on the upside. But I want to see, again, confirmation across the board with the three widely followed US markets. You can see here the Nasdaq, it has been holding up relatively well, and I'm going to show you why that is. If I switch to the exponential moving averages, you can see we're still holding above the 50. Now, for the most, or at least the majority of September, and even if I zoom it out and show you this, since July and since breaking out above that 5,123 area, the Nasdaq has been constructive. It has been rather healthy. The reason I say that is because we're still holding above the 10, or we have been holding above the 10 and the 20. And when we have broken either one of these, or one or two of these exponentials, we've been bought at the 50. Here we are at the current juncture. If I zoom back in onto the most recent sort of monthly trading activity since September, is that these exponential moving averages, they're really starting to flatten out. And if anything, the 10 and the 20 is starting to turn down. The 50 is still healthy. We are still holding above the 50, but it isn't the case on the Dow Jones Industrial Average nor the S&P 500. As you can see, we're actually failing at the 50, and we've also crossed below the 10 and the 20 quite a long time ago. If I zoom in and at least show you this, we failed here above the 50, we failed here above the 50, we failed once again here above the 50, here again on the 50, and we got a shooting star on on Monday this week. And then on Tuesday, we saw that big selling day take place on the Dow. Again, it hasn't translated through to the break of 17,970. We had that spinning top little inside day candle on Wednesday. But what I'm trying to show you is that people are selling the Dow at the 50. And at the moment, price is below both the 10, the 20, and the 50. And we are in a bearish alignment of the moving average trio. If I change to the S&P 500, again, you can see the failure above the 50, the failure above the 50, the failure above the 50, a couple more candles over here, another shooting star candle on Monday. Tuesday ushered in that sell-off, but as I was trying to explain before, we aren't seeing any commitment above or below certain ranges, and that's why we're paying attention to these ranges. Once we see the piercing of these ranges, we should see the majority, at least short-term majority, of price consensus that, which is telling us that, hey, price is about to move in a rather, considerable direction, at least seeing some follow through and to break out of this rather stagnant range. So this is setting up right now. If you've been following the markets again closely, we've been paying very close attention to this in Pro, and we're waiting for these ranges to break. It would be foolish in a way to sort of have had the discipline to sit here and not be that active, to really pass on trades because of this inactivity, or at least the non-committal state of the markets. But what I'm trying to say right now is that, look, we're very close to seeing a resolution to this. And it wouldn't be good for you to sit through, the past 3 to 4 weeks of price activity and miss out on this move, which is about to take place. I cannot tell you definitively when the move will take place, but according to these Bollinger Bands, we are going to see, some form of a resolution sooner rather than later. And it looks as though potentially that Monday, Tuesday, with that shooting star followed by that long day Morobozu candlestick, it may be suggesting that we are seeing again the beginning of a little intermediate pullback in the market. Whether or not this is some form of an inflection point on the market, it's too early to say. But if I very quickly change to the oscillating indicators, and just to show you this, I'll take the annotations off my screen right here. You can see that even on the monthly charts, having a look at the MACD, which is very important for divergence, and this is going out onto the monthly chart, which very rarely we see divergence, and especially on market indices. You can see that when we've pushed on up to this new relative all-time high, we're seeing some very strong divergence on the monthly MACD, which is very, very rare. Again, we're seeing it on the relative strength, or on the RSI, pardon me, and also on the stochastics as well. This is across the board. The Dow Jones Industrial Average, if I move my screen, we've put in a new relative all-time high. What is the MACD showing us? It is showing us monthly negative divergence. This is shown up on the weekly charts, which we've been paying attention to all the way back to the beginning of 2015, which have failed to actually materialize. Yes, at the moment, we haven't seen a break of these structural lows, but if anything, this divergence is a major warning signal. I know I've said that in the past, but again, eventually this divergence will play out, and it is a major warning for people who may be potentially complacent up and around these all-time highs. It looks as though we are set for some form of an intermediate pullback. At the moment, it hasn't eventuated, but pay attention to those Bollinger Bands as we move into Thursday's trading session. If they continue to squeeze, if we don't see, a structural break this week, we'll then pay even closer attention to them, because most likely they will be even tighter. They will be constricting price, and eventually we are going to see a major break one direction or another. Above all, stay neutral at this point, and let price guide you when, of course, those structural areas are broken. And that's when the floodgates will open in terms of individual trade setups, which are going to flow through to commitment one direction or another in our top 12 individual trade list. Okay, so that was just this pre-market update for Thursday, the 13th of October 2016. Continue to remain, I guess, disciplined in your approach to the financial markets. Yes, they are tempting at times to jump on in and to play some trades, but look, once this momentum gets settled or once it gets moving, it's going to move really, really quickly. This is like a pressure cooker which has been building. It has been building longer than September. We have at least seen some sort of lower highs setting up across the board in these markets, which again have failed to produce some form of a reversal. I'm not saying that we are setting up a reversal, but it looks as though we are putting in some very strong lower highs right now, and the pressure is building. Wait for the volatility to sort of explode above or be below these ranges, and that's where the money is going to be made on momentum trades in our top 12 individual trade list. Other than that, everyone, all the best. This is James on behalf of Pivot Point Trading. I'll see you over the weekend in Pro. Goodbye.